Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Friday, July 10th, 2020. And our top stories today, we'll take a look at private market investments in diversified portfolios and also discuss the applications potentially for retirement plans. Joining me now to discuss this and more is Gregory Brown. He is a professor of finance with UNC Chapel Hill, and he's also a research director for the Institute for Private Capital. Gregory, thanks so much for joining us on the program this morning.
Well, thanks for having me, Jeffrey.
It's great to see you, great to talk with you. I'm really interested to learn more about private markets. Before we do, I know you're a professor at UNC Chapel Hill. Just want to check in how you all are doing in Chapel Hill and any thoughts about potentially reopening in the fall.
Oh, sure. Yeah, well, we're hanging in there. I think it's been a big shock for everybody in the higher ed community. We're actually planning on starting our undergraduate courses a little bit earlier than usual, trying to finish up before Thanksgiving. So I think people feel like there's a lot of risk to leaving campus and coming back, and potential for additional risk as the weather gets colder in the winter. But I think we're prepared for it. We already do a lot of online teaching at UNC and out of the business school, so we feel like we're in good shape compared to a lot of other business schools. But I think there are certainly going to be unknown challenges at this point as we head into the fall.
Yeah, I think that's a gross understatement. I think we're kind of being very flexible, and things are changing, ebbing and flowing depending on the news that we're receiving. So let's jump right in. And I know that while you're also a professor at UNC Chapel Hill, you also are the research director for the Institute for Private Capital. Right before we get into the actual research and talk about what you found in terms of private markets, would you mind just sharing a little bit with the audience about IPC and what that organization is?
Oh, sure. Yeah. So we started about a little more than 10 years ago. There was a group of academic researchers that, we saw the growing importance of private capital markets, but we sort of also recognized that there wasn't nearly as much known about private markets as public markets. We have probably close to a century of empirical research now on how public markets of different types work. But because of the novelty of private equity and real estate private equity and other types of private funds, the data just wasn't out there in the public domain to do the research. So really what the Institute fundamentally was focused on was getting access to research quality data so we could really understand more about what private markets meant to investors.
Very, very interesting. And you mentioned private markets, and just for the benefit of the audience, I think you talked about some of the sectors of the economy. So when most people think about markets in the stock market, they're talking about public markets. When they think of private markets, they're thinking about alternative investments like direct real estate, private equity, hedge funds. Did I miss anything there?
No, I mean, the way I describe it, sort of tongue in cheek, is we're interested in any sort of financial intermediation that doesn't have a CUSIP. So that could be it could be a private equity fund or a venture capital fund or infrastructure or private credit. There's lots of interesting things happening out there that are hard to observe. So to the extent that things like leasing and trade credit are an important part of the financial system, I think we'd like to understand those better at some point as well. We're not actively doing research in every possible nook and cranny, but I think there is just as the financial system has gotten more complicated, there's more and more to understand to have a complete view of what is happening in the economy.
So when we talk about private markets, and you kind of alluded to this in your kind of run up and introduction, but we know so much about the private markets, but why, or the public markets over the last century, we've got all this data, and it just seems from the outside looking in, I'm not an expert in alternatives or the experts in the markets, but return streams aren't necessarily there, and so you're seeing institutional investors in particular, whether they're pension funds or endowments or foundations, anyone really kind of looking at these other opportunities to diversify. But what can you tell us about maybe some of the return streams and some of the research that you and the IPC have done in this area? Because I think it's amazing and interesting and adds some depth to the market.
Sure. Yeah, it's a classic finance context. There's really ultimately two things that should matter to investors. One is returns, and then the other is risk. And we didn't know much about either of those for things like private equity, buyout funds and venture capital funds when we started this endeavor 10 years ago. In fact, you could drive a truck through different estimates of what historical buyout fund returns were a decade ago. So one database would be off by 1,000 basis points compared to another database, and people really didn't know which number was right. And of course, the people that were wanting to be evaluated to a benchmark would pick the low benchmark, and the people that were against it would pick the high benchmark, and it was kind of chaos. So I mean, the very first thing we wanted to do was just better understand what historical returns had been. So what we did was went on a quest to go try to find this data, and we talked to a lot of different people that we thought might have access to the data. And the nature of private markets, I mean, that word private is important. People don't really want to share a lot about what they're doing in many cases. So we had to find someone that had a fairly comprehensive database, one that was fairly clean, free of statistical bias and reporting bias and such. The database relationship that's most valuable to us for private equity, at least, is Burgess. And Burgess sort of started out as sort of a accounting back office solution to large limited institutional investors. Limited partner institutional investors. And so they just through the course of their business had collected essentially the checkbook data for institutional investors. They had things down to the penny, down to the day in terms of what the actual investment cash flow experience was for the limited partners. So that was a gold mine for us. And from that, we were able to figure out, with quite a high degree of precision, that private equity looks like it is fairly consistently outperformed public equity over a long period of time. So, we think that sort of a sufficiently large data set came into existence sometime in the mid 80s. That's really when the kind of institutional buyout market, kind of came into existence. There were some funds before that, but not a large enough set to be sort of statistically reliable. And then we have data all the way up to the end of last year. And so what we found is that a typical buyout fund has outperformed a public benchmark by on the order of 300 basis points per year.
Wow!
So that's a pretty significant amount. Now that doesn't necessarily mean that it's a great deal, right? Because you also have to figure in the risk side of it too. So if you're getting 300 basis points of additional return, but that's just fair compensation for risk, then it isn't like there's a magic pony there that's going to solve all your problems in terms of higher returns, or at least higher risk-adjusted returns. So the second part of the component is to try to understand what the risk is, and I think this is still an active debate among academics. Exactly what risks are you taking with private equity? We know that there's different industries, there are different sizes. There's obviously illiquidity associated with the asset class. So I'd say there's still a pretty active debate there. But even when we sort of adjust, like if we use a benchmark that's a small cap value benchmark, which you might think is more like a typical private equity portfolio company, and even if we lever it up a little bit, so people observe that private equity-backed companies tend to have more leverage. So we do those things. It still looks like there's some excess returns there, and maybe that's fair compensation for the illiquidity risk, or maybe that's a little bit of alpha. But at least we know on sort of just a nominal basis, the returns to private equity have been higher than sort of just an unlevered, broad institutional benchmark.
And in terms of the transparency, it sounds like you make the point that LPs or private equity firms, obviously people don't like to share the special sauce, right? I mean, that's the benefit of hiring a private market firm. But it sounds like the transparency that you're creating through your report actually sheds the light and can open the door to other types of investors. I know we're going to get into this in the second part of the show, but it just seems like that transparency actually could be a good thing and work to the best interest of everybody, from the investor, the institutional investor, the individual investor, but also the LP that's always seeking to grow its list of investors.
Yeah, and I think there's a lot more transparency now than there was 10 or 20 years ago. And I think because the market is become quite institutionalized, and there's professional consultants and sophisticated investors out there that really want to look through and understand where the value creation happens. That's necessitated additional transparency. Obviously, the industry struggles with PR challenges, and so to the extent that they can be more transparent about the good things that happen with private equity, that helps them. So, we see some additional voluntary disclosure on the part of general partners as well. But it still is very hard to do research, especially at the portfolio company level, if you want to look through from an academic standpoint, because we just don't, we can't force anyone to provide disclosure, the same kind of disclosure you would get through a public company and an SEC filing, for example. So it's still fairly high level view that we have at the fund level.
Yeah. Well, I mean, I think it's interesting. It's important. You point to the fact that people always like to point to the boogeyman, right, and say this is a bad thing. I think with more transparency and more understanding, more education, really, you learn what the good and bad. Because I don't think anything is all bad. I don't think anything is all good. There's gives and take everywhere. Gregory, I'm going to take a quick break, but we're going to come back. When we come back, we'll talk to Gregory about potential applications of the research that IPC did with DeColta, the Defined Contribution Alternative Association, right after this. So stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive Fibrex composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to Gregory Brown. He is a professor of finance at UNC Chapel Hill, and he's also the research director, at the Institute for Private Capital. Gregory, thanks so much for sticking around with us this morning.
You bet.
Well, so really interesting lesson. I learned a lot about from the research and what you articulated in segment 1. Now I want to shift gears. Our show's about retirement and savings and personal finance and how all those things intersect together. And I know that IPC conducted some research along with the Defined Contribution Alternatives Association to maybe see how private equity and these types of structures can maybe apply in that context. What can you tell us from that research that you all did?
Sure. Yeah. So as I mentioned previously, we feel pretty confident now that private equity has historically outperformed public equity. So then I think the next logical question is, well, how does that impact a broader portfolio? Because we know when you add assets to a portfolio, it isn't just a simple kind of linear addition in terms of what happens to the risk. It really matters what the correlation is between assets and the amount of diversification that you get. So here's a question: how much diversification would you have gotten historically by adding private equity or venture capital or real estate, other private assets to a diversified public equity portfolio? So what we did was we did a simulation, a simulation experiment where we said, okay, let's take a traditional 60% stock, 40% bond going. Let's assume it's just Vanguard index funds to keep it simple. And then we're going to take 20% of the equity and we're going to replace that public total stock market index for Vanguard with allocation to private equity. Right. And so you might think that's really an easy thing to do, and you can just take whatever the index return is for private equity. But it's not that simple, because when you invest in a private equity fund or a venture capital fund or a real estate fund, you don't control when the cash flows happen. Right. The partnership, the general partner, controls when they call the capital and when they return the capital. So if you want a 20% target, you can't just call them up and say, I want 20% of my portfolio in a buyout fund. You make a commitment, and over the course of the next several years, that commitment gets called down. And so we need to track, like, what is the actual real portfolio experience of an investor when they allocate to private markets? How invested are they? What does this mean for returns? What does it mean for risk? And it's actually a complicated process, because not only do you have to worry about these allocations that aren't exactly what your target allocation is, you also have to worry about the fact that you don't observe prices, right? So all you get are the quarterly net asset values for funds. And we know that those are sort of accounting numbers. They're artificially smooth. They probably don't reflect what the true market value is of those funds. The true market value is unknown. There's no publicly traded price that you can observe. But there are statistical methods that you can use to kind of undo that smoothing and get a better estimate of what risk actually would be for this overall portfolio. So we do all these kind of complicated simulations and calculations. And what we find is that there's actually a pretty significant overall portfolio benefit to adding private equity and venture capital and real estate to a already diversified portfolio. So you're getting higher returns, and you're actually also getting lower risk. So you're getting a benefit in sort of both of the meaningful directions that investors should care about. So, for example, just as a ballpark number, if you were to add 20% of the universe of private investments, so you just randomly select funds and stick them in there and make a 20% allocation to that, you're going to increase long run returns over the horizon we looked at. It's about a 25-year period, by about 100 basis points for the overall portfolio. So that's pretty good. And you're going to lower the standard deviation of that portfolio by 1% or 2% as well. So, these are sort of not trivial benefits that would have happened historically. Now, what's going to happen going forward? Of course, nobody knows, sure, right? It could be that the next 25 years are terrible. There's no way to make that forecast. But at least we know that historically, over a pretty long period of time, with a pretty reliable data set and a careful methodology, it does look like there's been real benefits to investors to investing in private markets.
And there is precedence for this, right? Because when you look at superannuation fund, I think in Australia is an example where they use private equity and other alternatives as a diversifier. You look at some of the pensions here in the United States, whether it be CalPERS, which is the largest pension fund here, and even pension funds across the globe, they have been using these products, for lack of a better term, these investments as diversifiers and adding additional alpha to reach their assumed interest rate, right? I mean, their assumed return. They need that in order to gain alpha. But when you look at opportunistically, and this is a big conversation now happening in the defined contribution space, and I know you're not an expert per se in retirement, but we have in the DC space what are called target date funds, and many investors I think 80% of all new contributions are going in these funds. It stands to reason, just from my perspective as someone who's been in space for a long time, to give the opportunity to diversify like you would in a private pension or a public pension or in a larger pool of assets.
Yeah, no, I think that's the fundamental issue and fundamental question is, can you in a safe and reliable way add allocations to private assets to a target date fund or some other structured investment vehicle that has basically the equivalent of daily liquidity, right? And there is this liquidity mismatch, right? You look at a 48 Act fund and it's supposed to be precisely marked on a daily basis, and you'll be able to do redemptions and contributions at that daily mark. Mm-hmm. And that's a much more difficult thing to do with private assets. So you need to have some infrastructure there that allows the incorporation of private assets in a way that is robust. And I think that technology exists. It's probably something that is going to take additional research and work and some industry innovation to really make it commonplace and robust. It's probably easier to do in a government or large corporate pension setting than it is with a typical target date fund you would offer to a retail investor. And even in Australia, they had some recent challenges with the pandemic where the government was letting people take money out in a way that was very unexpected. Yep. There was no way for the managers there to anticipate that liquidity need, and it created some concern about what that meant for the private portfolio. So it is more complex. I don't want to give the impression that there aren't additional things that would be involved with making an allocation to private assets. But I think it is something that would benefit most investors if it can be done in a way that is safe and robust. I think that if investors can get that extra 100 basis points and do it with a lower risk, if they have a long investment horizon, that's probably a good thing. You would not want to see people allocating 50 or 70 or 100% to a very illiquid private portfolio in the retirement plans. But I think numbers in the 10-15% range are certainly very, very reasonable numbers.
And if it were controlled by a fiduciary or someone who had that fiduciary standard that they had to do something for the benefit of the participant, the beneficiary in the plan, now you're legally required to do that. And if that group had the ability to all the research that you're doing and others to kind of make the case and to monitor these investments over time, that sounds to me like the more prudent approach.
Oh, of course, yeah, and due diligence is a difficult activity even for large institutional investors for a private equity fund. So you would not want to have that type of responsibility put onto retail investors.
Yeah, absolutely not. I mean, can you imagine them all lining up to go down to a private, knocking on the door and say, we want to do some due diligence? I mean, you don't even know what to look for. I mean, there are very sophisticated consultants and investment officers at these pension funds that have teams and teams of people to do that. But I agree with you. I think it can be ported over into perhaps in the DC system to give access to those. But I agree with you. You probably wouldn't want it in your standard self-directed brokerage account. Right. That seems like a problem waiting to happen. Well, Gregory, I want to thank you so much for joining us in the program this morning. Really interesting research, really interesting data, and we look forward to having you back on the program very soon.
Yeah, great. Thanks so much for having me.
And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to? Drop us a line. And don't forget, for all the news in retirement, markets, technology, personal finance, and more, check out today's edition of The Morning Pulse. And we're back again tomorrow for our weekly wrap-up show, BRN Weekly. I'll be joined by Alessandra Melito of Market Watch in the first segment. You're going to want to check it out. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Attention! The Centers for Medicare and Medicaid Services has officially authorized new benefits that Medicare Advantage plans may include. To get the benefits you deserve, you can call the Medicare Coverage Helpline.
Hi, I'm Joe Namath. If you're on Medicare, this is important information. I called the Medicare Coverage Helpline and they instantly looked up my coverage. In this one simple call, they offered to enroll me in a plan that includes rides to medical appointments, private home aides, doctors and nurses' visits by telephone, and even home-delivered meals. The plan also includes dental, vision, hearing, and prescription drug coverage, all at no additional cost.
Don't delay. Call to see if the new benefits are available in your area.
Call the number on your screen now. It's free.
Call 1-800-757-1451. That's 1-800-757-1451.